everyone, back to my channel. This is update week 3 on building a portfolio. The rules are every single week I'll be investing $50 to $100, as well as going over my reasons for certain investments. But before I move forward, there's a quick disclaimer. I am not a financial advisor. This video is strictly for entertainment purposes. So without further ado, let's begin. All right, so this week we got a little bit of a treat because I'll be investing in 3 different investments. First one, it stays true to the core and satellite strategy, which I went over last week. Make sure to check it out. And this is essentially an ETF that tracks the S&P 500, and that's just to get that 10% return that the total market typically brings. And secondly, I'll be investing in REITs. This enables you to invest in real estate. And the last one is called AcuityAD Inc. Okay, so as part of the core satellite strategy, you invest ETFs that track the S&P 500. So here I have an ETF called SPLG. The price is $49.27 USD. And there's a couple of things that I look at to kind of evaluate an ETF. One is the expense ratio. Here it's 0.03%, which is relatively cheap. So just to put that in perspective, if you were to invest $10,000 into this ETF, you'd be paying $3. The second thing I look at is its performance. Does it track the S&P? Is its returns similar or greater than the returns of the top 500 companies? And here you can see that it actually is, so it does do a good job tracking S&P 500. Alright, so next on the agenda is to invest in real estate. It's a very simple way to do this, and you can do it by buying REITs. REITs are companies that make their money from real estate, and they go about it typically through 2 ways. One is by collecting rent from their tenants. So they'll own an array of different properties, such as commercial properties and residential properties. And 2, there are REITs that actually sell mortgages and then collect their revenue from the interest. It's important to keep in mind of the 90% rule. And this is essentially a mandate. So if any company wants to be considered a legitimate REIT, they must pay 90% of their taxable income to shareholders. There is quite a bit of complexity, so I do advise you to do your own research. But just in general, REITs tend to pay out higher dividends. And because REITs pay out higher dividends, there's less money to reinvest in the company and stimulate growth. So therefore, it's going to be difficult to find a high growth REITs stock. However, they're incredibly good if you just want solid, steady, passive income. Me personally, that sounds good to me, for sure. I like good dividends. However, I'm more focused on high growth stocks. So I try to find REITs that kind of exemplifies the best of both worlds. And one of the REITs that I came across is called Dream Industrial REITs. Okay, so this is the website for the Dream REITs. I figured I'd just go over a few bits of information to give you a general picture of what this company is about. So right here represents the different types of properties they own and invest in. As you can see, it ranges from office buildings to residential buildings to industrial buildings, as well as they're able to form communities that include all these different types of structures. They also give you the ability to look at their specific properties. So if you click on the portfolio tab, you can see that their properties are pretty scattered across the globe. They have the bulk of their properties are in Canada, but they also have some in Europe and the United States. They also allow you to look at their distribution of properties types. The one that caught my attention most was their industrial properties. So as you can see, they have quite a bit. They're approximately 34 pages that list all their different industrial properties. Part of the reason I was interested in this was because I noticed that in terms of business, a lot of it has shifted to e-commerce. And as a result, people rely more on these industrial properties to either store or make these products. Okay, so I'm on Simply Wall Street. The idea is just to raise to your attention some fundamentals of their financial health that I'm paying attention to. One is that the census of experts believe that the share price are undervalued and that a fair value would be $20. That's approximately 20% more than what it is now. So another metric is their past earnings growth. As you can see, relative to the industry standards, they've done well. For the past 5 years, they've had an annual growth of 52.7% of earnings. However, you can see that the last year, this REITs, as well as the overall REITs industry, has taken a pretty significant hit of negative 25.6%. However, this REIT still remained to be positive of 9.8%, and that's likely due to their industrial properties that still allow them to maintain positive revenue. All right, so finally is their dividends, which seems to be relatively high to industry standards. Right now, it is 5.07%, which is within the top 25% of dividend payers in the Canadian market. Okay, so that's just a bit of information regarding Dream REITs. Another cool thing about their dividends is that they pay out on a monthly basis. So I'll be able to track the growth in passive income in a more immediate and gratifying way. In addition, I'll probably buy more shares over the next couple months, as well as other REITs where their portfolio comprises mainly of, say, residential properties as well as commercial properties, as I expect that sector of real estate to grow as the economy opens up again. All right, so last but not least, the company that I'll be investing in this week and over the period of a couple of months is called AcuityAD Holding Inc., ticker symbol AT.TO. As you know, advertising is a key method in driving traffic to your business, as well as directing your business towards potential customers that are likely to buy your product or services. AcuityAds makes this process easy for companies. Their technology uses AI, and the idea is to collect and learn from data and increasingly optimize marketing strategies geared towards existing customers, as well as to identify new audiences that the company likely never considered before. So as I mentioned before, advertising is key to businesses. This is why a company like AcuityAds would be extremely valuable. As usual, I'm just going to go over a few things that I'm looking at regarding this company that kind of excites me and has convinced me this is a good buy. One is the opinions of other analysts. For the most part, analysts have been giving a strong to moderate buy of this company. As you can see here, it's currently at $11.77. Analysts think that a good price that it will go up to is $24.80, and the high mark is $33. Okay, so it's important. Okay, all right. Okay, so moving forward is their earnings growth. Analysts forecast that their earnings for the next 3 years at least will be greater than the industry standard as well as the overall market. is projected to have a 41.3% growth rate annually. However, it's important to acknowledge that the pandemic has impacted their revenue streams just like many other companies. This is a paragraph taken directly from their financial report of the last quarter, and essentially says that they gain a significant portion of the revenue from the entertainment and travel industries, but because these industries were impacted, so has their revenue. And this can be a partial explanation as to why their stock prices dropped so dramatically. However, it is a good indication of a buy just because the economy is likely going to open up soon, and thus will also these revenue streams as well. And therefore, you can expect an increase of their earnings. In addition, the last piece of information I want to leave you with regarding this company is that it's slowly progressing to being available on the NASDAQ exchange. This will increase their exposure to a whole new set of investors. Okay, so in summary, I'm going to buy one SPLG. This is an ETF that tracks the S&P 500. Again, I'm still staying loyal to the core and satellite strategy. Second, I'm going to be buying 2 to 3 shares of Dream Industrial REITs. And finally, I'm going to do dollar cost averaging of AcuityAD shares. All right, so this then concludes week 3. Just for a disclaimer, I am not a financial advisor. This is solely for entertainment purposes. However, if you did like the video and want to stay tuned for this series and other future videos, just leave a like and subscribe. Peace out, and I'll see you next week.